Okay, let's get started. Here we have in front of us is a very simple and basic balance sheet. The idea here is just to show you a bare bones stripped down balance sheet to give you an idea of how they're laid out and what information is in a balance sheet. Every balance sheet should start off with a title, balance sheet right here. It's a good idea to always put a title on your financial documents. Sometimes we might see a comparative balance sheet that shows the balance sheets for multiple years. Next thing up next is the business name. This is the James Buchanan Farm, named after the Nobel Prize winner James Buchanan, who got his Nobel Prize in 1986. So the date on the balance sheet is December 31st, 1986. And I want to call your attention to the format of that date. It is not the year 1986. It is a specific day in 1986, because a balance sheet is supposed to be a snapshot that tells you exactly what's going on a specific day at a specific point in time. So this is the financial statement for December 31st, 1986, a very specific time at a very specific date. The next thing we have in a balance sheet are two big blocks. The first one is assets and the other one is liabilities and equity. Every balance sheet is laid out in these two big blocks. Sometimes you'll see these stacked on top of each other. So if it's a really complicated balance sheet, you might see assets on top and then liabilities and equity on the bottom. So don't let that throw you if you see it laid out a little bit differently. Here in the most basic format, this is how we tend to lay it out. The idea behind a balance sheet is it's based on the concept known as the fundamental accounting identity. And the fundamental accounting identity is simply that assets must equal equity plus liabilities. It's a very simple, straightforward formula. And if you're doing your accounting right, it by default must come out to that formula. Assets equals liability and plus equity. What I like to tell people is that liabilities and equity tells you who owns the assets. So the liabilities is where you've borrowed money, meaning that someone has a legal claim on your assets because you've got to pay the money back. And the equity is your net worth, your portion of the assets that belong to you. And we'll jump right down to the bottom real quick, and I want to show you that the assets are equal to the liabilities plus equity. They both total out to $358,000. And oh yeah, those should be formatted as dollars. That is the proper way to format these. All right, let's pop over to the assets section real quick. Typically, we're going to break assets into two types, current assets and non-current assets. You will see some spreadsheets that break it into current assets, intermediate assets, and long-term assets. But it's important that we break these things down into different categories that are based on some time horizon. And the important category time horizon you have to be thinking about is simply this. Am I going to turn this over in this accounting period, in this year, and take it and turn it into cash? If it's an asset that you plan to turn into cash at some point during the accounting period, then you're going to list it as a current asset. The example I always like to use is a hammer. If you are a carpenter and you're swinging a hammer, then your hammer is a non-current asset, because if you get rid of your hammer this year, you can't make any money next year. You need the hammer to get the job done. However, if you're a hardware store and you're selling hammers, then the hammer must be a current asset because you have to sell the hammer to make money. That's how you get the job done. Quick note on the formatting. The very first number that you list should have a $sign in front of it, and the rest can all just simply be delineated with commas. And it's always best to make sure that everything has the same number of decimals. I don't think you can see on the screen where I'm doing that, but that's okay. That's another day we can worry about. And after you total a number up, it should be dollar formatted as well. So we'll make everything with the same number of decimals. So basically what's going on here is this farm has $4,000 in cash and $12,000 in savings. So it's not unusual to list cash like in the checking account and in a bank account. And then this farm has some inventories. They have some livestock and they have some feed that they are going to, they're going to feed to the livestock and then turn that livestock into money, and they hope to do that as a part of the normal cycle of the business. And then we total up all of our current assets, and I've entered a formula in Excel to do that. It's just the sum of all of the other assets, which is interesting. I've made a mistake, and it's an easy mistake to fix. I'm just going to click here and drag down, and now it's going to sum up correctly. So our current assets are $96,000. So this farm has $96,000 worth of stuff that's either cash or they're going to turn into cash as a normal part of business during the next accounting cycle. All right, the next thing we have is our non-current assets. So these are things that we're going to hold on to over time in order to make money for ourselves. These things tend to be assets that depreciate, for example. Because when you depreciate, it means you're going to use something gradually over time and slowly destroy it over time. Things that count as non-current assets on a farm are things like breeding stock. Your bull, your cows, these kind of things are depreciable assets that you're going to hold for multiple years. Machinery and equipment, that's a big one on a farm. There's always tons of machinery and equipment. Various investments, there's oftentimes a long-term investment category listed as a non-current asset because it's a thing that's an asset that you don't want to turn into cash immediately. There's a second equipment line here. I'm not sure why there's a second equipment line here. That doesn't actually make any sense. I think perhaps we meant to call this one land and buildings. So that's the cool thing about Excel. When there's something wrong with it, you can just change it immediately. And then finally, there is an equipment line here. And so we total up all those items and we get $277,000 in non-current assets. And then we total our assets and we get simply summing these two categories, the total current and non-current, and we get a sum of $373,000. So this farm is sitting on $373,000 worth of assets. Now we're going to pop over to the liability side of things and take a look at the liabilities on this operation. Liabilities, like assets, tend to be broken down into current liabilities and long-term liabilities. Again, you sometimes see things like intermediate liabilities. The key distinction is exactly the same. Current liabilities are things that have to be paid in the next year, in the next accounting cycle. So these are things that have to be paid off very soon. And these are some of the things that tend to pop up in current liabilities. It's not an exhaustive list. This is just kind of a short-term idea. The first thing is accounts payable. So accounts payable, that's basically where you've gone to the feed store and picked up an item to feed to your cattle, but you didn't pay for it the day you picked it up. They just put it on your account. It's a short-term credit. It's very common in business for businesses to take possession of inventory items and other items and not have to pay for them on the day that they take possession. So maybe they went to the feed store and picked up some feed supplement and they're simply told, hey, we'll put this on your account. You can pay us in 30, 60, 90 days, whatever the case may be. A lot of businesses have an accounts payable like this. And so in this case, we have $50,000 in accounts payable. Why don't we go ahead and turn that into dollar signs because that's the proper way to do it. Taxes payable. What you have to remember about taxes is they slowly accrue over time. Accrue means they build up. And sometimes we do accounting on what's called a cash basis, and sometimes we do it on what's called an accrual basis. The idea behind cash basis accounting is you only write it down when you pay the bill. And the idea behind the accrual method, it sounds like a cruel method, but it's not, it's accrual. And so you might slowly accrue taxes, and so you don't get hit with the bill. You set that money aside off into another account, and you keep up with it. And you write down as a liability because you have to pay them to somebody. So you have a liability with taxes. The next category is installment payments due. So this would be the immediate payment due on a long-term loan. So you might have a long-term loan on your property or something like that. And so you've got to pay some portion of that immediately. And these all total up to $56,000. And of course it is dollars. Then we have long-term liabilities. In this case, we just have one long-term note. So this might be a loan for a piece of property or loan for equipment or something along those lines. And you would kind of group all of your long-term notes together. And then we are going to subtotal that. And we have a $200,000 long-term notes. Then we have our owner's equity, our net worth. Now, a lot of people will try to calculate the net worth or the owner's equity here on the spreadsheet. And if you're just trying to show that you understand how the balance sheet works, that you have to have your assets equal to your liabilities and equity, I suppose that's okay if you're just trying to show a basic understanding of the balance sheet and show that you realize that liabilities and equity have to add up to assets. But in reality, the owner's equity, the net worth, is going to come from somewhere else in your accounting documents. And you would then put it on this balance sheet and then add it up and then check to make sure that the total liabilities and owner's equity of $373,000 is equal to the total of the assets of $373,000. And there you go. You've got a balance sheet. It's called a balance sheet because it has to balance. And that is the video on a simple balance sheet. I'm going to put together a video on an income statement as well as a more complicated balance sheet video to show you an example of what a balance sheet can look like when you start adding layers of complexity to it. Thank you very much for watching. Make sure that you hit subscribe so you don't miss the next update.